When I think about refunds and when I talk to clients, I think it actually, in a broader sense, as a strategically important issue for clients, but I think it in the context of their responsibilities very broadly fall into a number of areas. One is managing risk, two is managing working capital and opportunities, three is getting a compliance job done, and then a wrap around that is an efficient and effective structure and organisation. Some might add policy to that as well. So when I think about refunds in the context of that, I think about working capital management. I think about driving VAT, indirect taxes from the balance sheet.
Yeah, I totally agree with that. Of all the clients that I talk to about this topic, it's really about having visibility. So they might have good visibility of their VAT throughput, their total input tax globally, their output tax liability, but actually it's, do they have visibility of overseas VAT, foreign VAT that's being incurred? Do they have an understanding of where they're incurring foreign VAT? Do they have an understanding of the VAT on their intercompany balances and all of those different areas and how to manage those and strategically and proactively try and mitigate that?
In terms of first step, what do we see clients do? Well, some of my clients, where do they go searching for this VAT? Where's the first place you might look? I think you look in your accounts payable, understanding where the VAT has been charged by your suppliers. Is it being appropriately charged? Do you look in your accounts receivable? And there's lots of places, and we can talk a bit more about where the savings might be or the refunds might be. And then absolutely, I think intercompany, as you said, is a really good place to go hunting.
Yeah, I agree. And I think it varies from sector to sector. So I have many clients in the media sector, and especially if they're content producers and they're broadcasting, they're going filming on location, moving camera equipment, filming sporting events, all those types of events. That can be very costly. If you're moving equipment around, you might incur a lot of local VAT. If you're in different sectors, it might be more around trade conferences and those types of events. So I think it does vary from sector to sector. And for a lot of my clients, it's about understanding where those costs are likely to come up so that they can proactively engage with the stakeholders in the business in advance.
Agreed. And sectors, some examples around sectors. So we do some work around some more traditional box moving sectors. One of the areas that we go looking for is around global contracts.
Yep.
So do you have a global service contract with a telecoms provider or an IT provider that's negotiated at headquarters, but locally charged? Often there's areas where stuck VAT, and they might feed through to the P&L and actually be a cost in the P&L. So they're good areas to go looking.
I think one of the reasons I'm seeing this come up more and more in client conversations at the moment is actually there's quite a lot of overlap with BEPS. So because of BEPS, a lot of businesses are looking at restructuring a lot of their intercompany arrangements, their transfer pricing. That has a knock-on impact on the VAT on their transfer pricing and their intercompany charges. And a lot of my clients, suddenly they're looking at the extent to which their intercompany and their transfer pricing benefits the local market. And if it benefits the local market, often, especially outside the EU, those local markets might insist on local VAT being chargeable. So it all links in together, and more so, I'm doing work with my direct tax colleagues, with my employment tax colleagues around the short-term business traveller changes and how they're monitoring employee movements and the impact on VAT around that. So I'm seeing a lot more crossover between all the different areas of the tax and finance function more generally. And as a result, I'm having a lot broader discussions with clients around VAT reclaims and the strategy around managing that.
That's interesting.
And global tax authorities have so much greater visibility of businesses' global footprints now. With country by country reporting, they have a footprint of where a business has permanent establishments globally. If your VAT doesn't match that and doesn't support the transfer pricing position, then it's automatically a red flag to the local tax authorities. It's very easy for them to launch a tax audit. Now, more and more so, there's real-time reporting of VAT transactional data. You've got your standard audit file for tax in many countries. So again, it's really key that that data going in is correct. VAT reclaims, often they're only claimable once a year. If you're submitting your transactional data almost on a real-time basis, you need to be comfortable that it's correct rather than waiting till the end of the year before deciding whether you should have incurred VAT on those cross-border charges. So there's definitely a need to look into this and be proactive and try and manage this proactively rather than just waiting and seeing what you end up with.
And I think that's right. So you touched on something there, didn't you? Which is effectively the use of data, and in the context of refunds, I think it's becoming increasingly important.
Definitely.
So we've always, I think indirect tax and VAT in particular, and global trade and customs have always used data. It's a transactional based tax, but I think we're using it much more effectively now, and what's required to support a claim can often be significant amounts of data, and having appropriate data mining is going to be really key in terms of supporting claims. And we see most of the effort to support claims being through the data analytics and the evidence required.
And that links back to the point we were discussing earlier around visibility. If you can use your data to actually get visibility of how much you're incurring in the first place, then it really helps manage that whole process.
Yes. There's kind of two broad approaches, I think, and often they start with the first one, which is a one-off project. So what does a one-off project mean? You get a work stream together, either internally or with the help of an external provider, to identify opportunities, and you do a single review of your working capital, find out where the VAT is, find out where your customs duties are, and you try and drive that out through various mechanisms. The other, and I think a more sophisticated approach, is to, once you've done that, is to embed that into your processes on an ongoing basis, so that you aren't constantly going back on a yearly basis and reviewing, but it's part of your ongoing work. So that's the two broad areas of approach. I think then secondly, there's another choice to make, a mixture of a country-based approach and an issue-based. And what do I mean by an issue? An issue might be like, where can I claim bad debt relief that I'm not currently claiming bad debt relief? Am I being efficient and effective around the management of that? I think you can do a mixed approach. And I guess it would be interesting to swap stories on what areas we see as the most fertile. Where do we see the most sticking VAT? I guess the classics are Italy.
Yep.
And Brazil, if we're looking from I think many people will recognise those as two countries that it's very, very difficult to do it. So my clients, therefore, when they, with a view that they want to trade in those countries, but they try and mitigate that up front, which is often a challenge, and to do that still in a commercial environment. Yeah,
I think from a tech sector perspective, China as well, because you have a lot of tech businesses in China who are exporting globally, especially to UK customers, and VAT in China is not recoverable when it's charged cross-border as well. So China and Russia as well is another country where a lot of my clients end up with local VAT charges, and it's not recoverable.
And your point about the way that the business operates, really important. You know, it's really important to drive efficiencies from a VAT perspective. Sometimes that's just the cost of doing business, and you have to live with it. But if it's not, and you can restructure, then we can certainly see clients doing that as well. Yeah,
and just to build on your point around restructuring, I've been doing a lot of work with clients around how they can mitigate that VAT. So in some countries, it's possible to think about, you know, to what extent do the services benefit the local market? To what extent do the services benefit the international market? Can we invoice separately? Can we make sure the wording in the transfer pricing, the intercompany agreements is really clear, so that for VAT purposes, we don't end up with a local VAT charge unnecessarily on the full recharge, but only the element that should have local VAT on. So there are some practical process and control elements that can be built in as well.
And then coming back to the Italy example and the Brazilian example, so some of the things that we see clients doing, it's really important, it's not necessarily having some fancy structure, but actually being effective and efficient around the information that you capture and submit, and being very rigorous around the process for submitting claims, doing it on a timely basis to limit the cash flow impact.
Yeah.
The other area that we've seen and clients deploy is selling the VAT credit.
Yeah.
So we've done some work in Italy and elsewhere where there are certain financial institutions that will buy your VAT credit off you for a certain fee. Now that fee varies enormously depending on how how they think that credit, how much they think that credit's worth. But the best way to get the most from that would be to have the clearest claim that's been submitted on a timely basis with a really good, efficient evidence. That's the best way of getting the most money.
Yeah, it's kind of like a factoring arrangement.
Yeah.
But it's very interesting because in some countries, even if it is reclaimable, if the time that it's going to take to get your money back is so long that it effectively becomes a cost to the business, then yes, things like selling your credit might be the best option.
Yeah.
So Kevin, do you see technology playing a role in this?
I do. I think increasingly so. I mean, the digital world is upon us, and I think a number of things. It can give you greater visibility, it can give you greater analysis, and I think there's some opportunity there. One very specific example that I saw recently was a big utility company. It was in fact in Portugal. So what did they do? Their process for recovering bad debt relief from a VAT perspective was really onerous, really manual, really time consuming, and for relatively small return for the individual amounts they were talking about. So they didn't do it. But actually, through the use of technology, in particular around robots, which enabled them to go and collect data from third-party websites, from the tax authorities' websites, and from their own systems, they were able to create in a very efficient and effective way and start to recover millions of euros. So that I can see that as an example being expanded beyond.
So a couple of my clients have had some issues with some reclaims they've submitted that have resulted in other problems being identified. So one example would be one of my clients submitted a reclaim, and as a result of that reclaim, the tax authorities asked questions about the nature of the supplies, why they were incurring the VAT in the first place, and identified that they should have registered for VAT there. So immediately they have an assessment, they have penalties and interest. And if they'd thought about that in advance, they could have managed that and mitigated that. Another example is actually, it's more common than you might think, but quite a lot of my clients have ended up with TOMS assessments. So that's the Tour Operators Margin Scheme. And that's quite common around things like conferences. So if you have a multinational organisation and you're arranging a conference in one country, you might have the local operating entity arranging the conference, arranging all the accommodation and transport, and then recharging that to the local operating companies. When all the local operating companies try and reclaim the VAT that's been charged on that, the local tax authorities turn around and say, well, hang on, that local operating company is acting as a tour operator in that instance. So they have to register for the Tour Operators Margin Scheme and account for VAT on the margin. They can't reclaim any VAT on the associated costs. And it's a massive operational ordeal. And again, it's something that if they'd thought about that in advance and been aware of that, they could have managed that and avoided that issue coming up.
And I imagine most organisations do that.
It is very common.
Operator.
It's really become a bit of a hot topic recently, and I think that's due to the changing tax landscape. So we've already mentioned the Base Erosion and Profit Shifting Initiative, and that's having an impact on transfer pricing, direct tax, and all the intercompany transactions. Then there's also a lot of changes around short-term business travellers, which means that you might have greater visibility of where your employees are globally around the world, and a bit more focus around your strategy around mobility. And then there's also increased real-time tax reporting, or almost real-time tax reporting, increased data submission on data requirements. And I think all of those three areas are really merging to form a perfect storm for the tax authorities to have greater visibility of this area. And it means that businesses really want to try and get a better handle on this now.
The other areas that I've also seen clients consider this, because actually indirect tax people have a lot of value to add here, and unlocking the opportunities within your organisation can significantly drive value for your organisation.
Absolutely.
And we've seen many budgets coming under pressure. You know, organisationally they're being asked to cut costs. You see that on mergers. You see it on just general trading. We feel like there's a significant tightening of the belt that we've been asked of corporates from a global perspective. there is also global uncertainty about what the future is going to look like. What is the trade arrangements going to look like? You've got Brexit, you've got the trade arrangements with the US and Mr. Trump potentially changing many of those. What's that going to throw up from it? It's going to be a very interesting couple of years from an indirect tax perspective. I think that's a great opportunity to drive these savings into the business and show value.
Absolutely, and most businesses think of VAT as generally being recoverable, but you've mentioned Brexit, you've mentioned the US tax reform. Customs duty isn't recoverable, and if both of those areas have a massive impact on your customs duty bill and your customs footprint, then that will immediately impact your overall indirect tax bill.
Absolutely. And the other thing that I see, because this is not a new area, trying to drive opportunities, what we've seen many organisations do slightly differently now is take a more global approach to this.
And I think that's really where the data comes in, because at the moment, if you're manually submitting claims in every single country around the world, that is extremely time consuming. Whereas if you can use data to analyse where your key receivables are, which are your largest territories where you're going to have reclaims, you can really help to make that process more efficient and reduce the time that's required.
Agreed.